Gold rate jumps to all-time high, but jewellery stocks are crashing. PC Jewellers Kalyan impacted. Titan sees demand strengthening. What's driving the Uno reverse effect?
Jewelry stocks have failed to keep pace with gold's blistering rally, so much so that at a time when gold prices have zoomed over 70% in a year, 8 of the top 10 gems and jewelry players in terms of market capitalization are languishing in the red on Dalal Street. Hello and welcome to another episode of Explained, brought to you by NewsX. I'm Uday Pratap Singh. Today we are breaking down why the numbers just don't add up, why jewelry stocks are underperforming even as gold prices continue to surge. We look at the reasons behind this disconnect and the possible alternatives investors are now considering. Barring Titan and Thanga Mayal jewelry, which have risen 17% and 72% respectively, other prominent names from the sector have plunged up to 44% in a year, highlighting a sharp divergence against the gold rates. PC Jewellers continues to be the biggest laggard in the pack, plunging nearly 44% over the past year. Close behind is Senco Gold, where the stock has crashed over 43.5%. Kalyan Jewellers also hasn't been spared either, with shares down about 35%, while Sky Gold and Diamonds has seen a sharp 38% erosion in value. Even recently listed players are feeding the heat. Ian Gadgil is down close to 15%, Bluestone Jewelry has slipped around 1%, and Moti Sons Jewellers has taken a severe hit, tumbling nearly 45% within a year, underscoring that the pressure is widespread and across both legacy names and new entrants in the jewelry space. Analysts have highlighted three key reasons why gold prices and gold jewelry stocks are moving in opposite directions. Pravesh Gaur, senior technical analyst at Swastika Investmart, and has said jewelry stocks have not moved in line with the sharp rise in gold prices. In fact, most listed jewelers have seen a meaningful correction in their share prices. He highlighted three main triggers. According to Pravesh, the biggest reason jewelry stocks are lagging behind despite gold's sharp rally is the rising cost of raw materials, particularly gold itself. Unlike finished products where price hikes can sometimes be absorbed or passed on, gold for jewelers is a direct input cost. As gold prices surge, it inflates the cost of inventory and significantly increases working capital needs for jewelers. This squeezes margins because jewelers don't make their profits from the raw gold, they make it from design, craftsmanship and making charges. When the price of gold climbs rapidly, it doesn't boost profitability, it makes jewelry more expensive for consumers, which in turn dampens demand. Higher gold rates can therefore erode affordability, slow buying activity and ultimately put pressure on sales and profit margins across the sector. Another key reason weighing on jewelry stocks is weak volume growth. As gold prices rise sharply, jewelry becomes more expensive, forcing many customers to either postpone their purchases or shift towards lighter, lower value pieces. While the ticket size may remain high because of gold prices, the actual quantity of jewelry sold declines, and that hurts overall volumes. This directly impacts operating leverage because jewelers depend on higher sales volumes to spread fixed costs like store rentals, staff, as well as marketing. The effect becomes even more pronounced during weddings and festive seasons, traditionally the strongest demand periods where consumers are far more price sensitive. Instead of splurging, buyers become cautious, trimming purchases or waiting for price corrections, which further dent sales momentum. However, Titan has emerged as a clear outlier in this challenging environment. The company has managed to outperform its peers due to its strong brand recall, superior pricing power and disciplined business practices. Titan's scale allows it to manage inventory more efficiently and use hedging strategies to reduce the impact of volatile gold prices. This helps cushion margin pressure and maintain consumer confidence, advantages that many smaller or heavily leveraged jewelry players simply do not have. Lower liquidity is another major pressure point for jewelry stocks. According to Pravesh Gaur, rising internet rates and tighter liquidity conditions have disproportionately hurt jewelers with higher debt levels and heavy inventory funding requirements. As gold prices rise, jewelers need more capital to finance the same quantity of stock. This increases borrowing costs, strains cash flows and leaves highly leveraged players vulnerable, especially those without strong balance sheets or efficient inventory cycles. On the demand side, the impact of high gold prices is not uniform. Sonali Shah Sheth, founder and creative director at Sona, points out that record high gold prices are clearly influencing consumer behavior, but in a nuanced way. There is a visible wait-and-watch sentiment amongst a section of buyers who are holding back purchases in anticipation of a price correction. At the same time, another group believes prices may rise further, prompting them to go ahead with planned purchases despite higher costs. Cultural factors continue to provide a safety net. In India, weddings remain a powerful demand driver and continue to cushion the overall impact of elevated prices. Alongside this, there is steady soft demand from consumers who increasingly view gold as a long-term store of value. These buyers may not splurge, but they continue to make smaller, thoughtful purchases tied to important occasions. A gradual shift in consumer preference is also emerging now. Sheth notes growing curiosity around lower carat gold. While 22 carat gold remains the traditional preference, buyers are increasingly open to 18 carat jewelry, especially for design-led and contemporary pieces. 14 carat gold is gaining acceptance in smaller gifting categories. Some brands are experimenting with 9 carat gold, but this trend is still at a very early stage and far from mainstream adoption. Currency weakness has added another layer of complexity. Mumbai-based dealer has stated that the weakening rupee has made gold even more expensive for Indian buyers. Since gold is imported and priced in dollars, for jewelers, this has created uncertainty around inventory decisions, making it harder to determine when to stock up and how much to buy, further tightening liquidity and increasing risk. Data comparing gold prices between December 2024 and December 2025 shows a sharp jump in rates across both segments. The price per 10 grams of 24 karat gold used in bars and coins, as well as 22 karat gold used in jewelry, it surged by over 65% during this period. This steep rise underscores gold's role as a hedge against inflation and reflects the impact of global market volatility, persistent geopolitical tensions, and heightened risk aversion amongst investors. Joining us now to discuss this further is Dr. Jaydeep Bhattacharya, President CDEPR. Dr. Bhattacharya, welcome. Thank you for being with us. What explains this unpredictability in jewelry stocks in the market?
I think you've covered most of the reasons there, but in addition to that, you were talking about Titan as an example. Titan has 3 different brands, which is targeting 3 different price points. As you rightly said, there's been a bit of a crash in terms of the high value jewelry. And so Titan has Tanishq, it's got Mia, it's got CaratLane, which is targeting multiple segments. And therefore, it's able to maintain that momentum. But it's maintaining that momentum in a background where there has been a 1% reduction in CAGR year on year since 2018. So it's been a long time that Indians have reduced their consumption of gold over a period of from 2018 to 2025. So as it is, Indians were reducing the consumption of gold. And in that context, it was quite questionable as to why the PE ratios, which is the price to earning ratios of some of the jewelry stocks, were extremely high. There was some expectation that perhaps the consumption of gold will go up because of the risks being perceived in the global market, and which is why the price of gold had anyways gone up in the first place, because of risk that was perceived. Somehow it was believed that because of that risk, people will go ahead and start buying gold jewelry, and therefore the PE ratios were high, which means the stocks were anyways overvalued. And now that it has gone on for such a long time, there seems to be a bit of a correction happening in the stocks, because the increase in demand hasn't happened. We continue to have reduction in demand. In fact, some of the jewelry has moved into studded jewelry, which is a higher margin. As you know, the stocks do not value the cost of the product sold. It basically values what is a margin that the company is earning. That margin has got reduced because the input cost, which is essentially gold in this particular case, has gone up, and therefore it has squeezed the margin. The market is not ready to pay for that higher price. So if the inputs go up and the market is not ready to pay the increased price, then it's only the margin which gets squeezed, which is where, because of these multiple factors, we see that the price of some of these stocks have gone down.
Yes.
But also in addition, what is happening is that the rupee cost has gone up, which has further increased the cost of gold in rupee terms, and which also prevents some of the gold players in going ahead and buying more gold, because it is expected that the rupee will become stronger in the short run. The moment the US-India deal is signed, the rupee will become stronger, which means that if I buy gold at the current rate of rupee, I'll be ending up paying much more. And then when the rupee cost crashes, then people who will buy gold at that point in time will find that gold to be cheaper. And so I'll be stuck with high cost inventory of gold, which is why a lot of the jewelry players are actually not even going ahead and buying gold, which means that their stocks are significantly lowered. So it's a combination of these factors, Uday, which is actually leading to the situation we're talking about. And therefore, companies which are able to manage this supply chain, manage their inventory well, is able to manage just enough inventory so that once the rupee becomes stronger, they will be able to liquidate their stock very, very quickly.
Okay. That
and
explains
is able
what the trends have been earlier in the year. Very quickly before we wrap up, what do you believe is going to be the trend in 2026? Where do you see these stocks performances going in the new year?
I strongly believe that they will come back on track. These are very strong companies, and they've had a good track record.
Right.
So as soon as I believe the geopolitical situation stabilizes, and we have the India-US deal in place, I believe some of these companies will be able to start procuring gold at a lower cost.
Let's leave it at that. Dr. Bhattacharya, I appreciate you joining us with your perspective on this big story.
Gold rate jumps to all-time high, but jewellery stocks are crashing. PC Jewellers Kalyan impacted. Titan sees demand strengthening. What's driving the Uno reverse effect?